The first one up here is Starbucks CEO got interviewed by Cramer, and things got very tense in this interview. Very, very tense. So we're going to get into that one, okay?
Quarter was extremely weak.
Jim, it was a very tough quarter. Thank you for having me. There were three reasons for this. First, we saw unexpected pressures on our occasional customers, more intense than we expected, that impacted their visitation. Second, the choppiness of the recovery in China continued with a more intense price war than what we expected. And third, challenges of our business in the Middle East that impacted us not just in the Middle East, but also in other geographies.
Okay.
Clearly,
I understand. Now, what I'm trying to figure out, sir, is why did you not feel the need to pre-announce this shortfall, given the fact in the previous quarter, your CFO said that she felt that you could have a earnings per share growth in the range of 15 to 20%. This is a substantial decline from that. And given the fact that you said on the call that April did not end well, I'd like to know why you did not feel the need to come out and say our quarter is going to be substantially worse than expected at least 4 weeks ago.
So this is a good question by Cramer here. And for those of you guys that maybe haven't been in the market very long, this is a very important subject, okay? A pre-announcement of a quarter is when things are so bad that you got to let investors know, okay? And it's kind of a responsibility to you as a CEO of a company to come in and say, we're going to pre-announce this number. Because if things are so bad or so great, you can always pre-announce. And I watched a lot of pre-announcements happen when I was actually first getting in the stock market. This was around like 2008, 2009, the Great Recession was going on, and companies were pre-announcing left and right because their businesses were in such a bad place. So, right now, this might have actually been a good time for Starbucks to come out and pre-announce how bad things really were.
I think, Jim, we've been working on action plans to address these headwinds. And so what we wanted to come back with was not just the announcement, but also the action plans that we have in place, which, by the way, are not business as usual. And I'm happy to talk about them.
Well, let's finish, because I know that investors are trying to figure out why they should hold on to the stock. Some of the things that I am confused about, I checked with all the major, both public and private companies that are in a similar business to you, and no one saw a 3% decline in comp stores because of weather, and none of them saw a negative number except for you. Is it possible that your coffee is just too darn expensive?
Jim, I think that if I look at the U.S. occasional customer, they have clearly cut back on visits to us. If you look at the value for money scores we have, they're still strong. But there's no question that the occasional customer is cutting back on visits to us. We have not been able to communicate to them the value that we provide. So what we are doing about it is it's not business as usual, but there's an action plan we have in place in order to do that, to reach them and to communicate the value that we are providing. What we're doing for that is we are making it attractive for them to come back into the Starbucks app and join it. On the app, what you will see is value that they haven't seen because they've not been part of that environment. There are drops that are going to happen every Monday. There are bundles that we're putting in place that are attractive for them. For example, a beverage and a drink at a certain price. And so what you're seeing there is the effort we're making in order to ensure that our occasional customers get to see the value that we provide.
Why did the loyalty program go from 34.3 to 32.8 in linked quarter? I mean, those people are not occasional. Those people are hardcore. Why did your membership, and I know your membership was up 6% year over year. I'm not concerned with that. I'm concerned with linked quarter. Why you had not the occasional, but the hardcore drop off.
Jim, if you look at the most loyal customers, they actually continue to come in. They continue to buy us frequently. They continue to customize and upgrade. It's at the tail of the loyalty program, particularly those that are, in the 90-day active, as we call it. The folks that didn't come back, they again are very similar to the occasional customers. We have an action plan in place right now to communicate directly with them with offers that have gone out even as recent as this week in order to ensure that we can reverse the visitation losses that we have seen with them and to bring them back. And yes, you're right. Overall program did grow by 6%.
That's necessary,
19 to
but what's more
4?
important, I think, is the linked quarter decline. Now, let me, before I turn it over to my colleagues, you said it's not business as usual, and I want to make a point here, sir. You are still...
The thing with Buc-ee's is Buc-ee's was already a big giant, back then. Obviously, they're a much bigger company nowadays in 2024 than they were back in 2006, 2007, 2008. But they were still huge back then, and so that's crazy fall. It's like, what is that, like a 70% fall?
Expanding as if it is business as usual. You add, for instance, quarter decline. Now, let me, before I turn it over to my colleagues, you said it's not business as usual, and I want to make a point here, sir. You are still expanding as if it is business as usual. You add, for instance, on the quarter, you talk about opening stores in Honduras and Ecuador. Is it not time to pause, sir, and figure out what's really going wrong and spend a deep dive and making it so that this decline in comp store numbers does not continue? Because it is perilous to the actual existential existence of Starbucks.
Jim, thank you for the question. What I would tell you is, if you look across the world, our system sales in Latin America expanded double digits. Our sales in Japan expanded double digits. Our business outside of Malaysia and Indonesia in Asia Pacific showed growth. If you look at the U.S. business and look at the fundamentals of the U.S. business, we are holding share in the U.S. We are still the largest player in out-of-home coffee. If you look at some of the metrics that we have...
Tim Horton said you are not holding share, sir. I regard them as being seminal companies that are just as good when it comes to... McDonald's says you are losing share. I can't go against those three companies. They are too good and too honest and too big for me to dismiss.
We are the leading category player in coffee. I'm talking visitation share and what we have. If you look at our in-home coffee business, it grew share 140 basis points. But if you look at the business underpinning us, tea grew 8%, cold grew 1%. So
that's a rough graphic. That's a rough graphic they put up there. They put my man up there, and then they put his performance since he became CEO. Oh man, that's rough.
Elements in here. If you look at our partner sentiment and what we have inside stores, attrition is down to its lowest levels. So there's work going in. The thing we didn't do enough of is really attack the occasional customer with delivering and communicating value to them in a more aggressive manner. That's what the plan we have does.
Luxman, it's David. China continues to be a not unimportant part of the growth plan for this company. You cite fierce competition there, a slower than expected recovery. But to Jim's question again, why not sort of focus on improving things there and or fighting off the competition? You still are opening many stores. I know the net number was still a pretty significant one for the quarter in China.
David, first of all, I think if you look at the overall network of stores that we have, they're in very good health. If you look at the cash-on-cash returns that we get from the new stores and the expansion, they're 40% cash-on-cash returns. We see no reason to change that equation. It does not mean that we're not focused on fixing the challenges we have with the occasional customer and with the fact that they're not visiting us as often.
Luxman, I was noted your language in terms of citing a deteriorating economic outlook weighing on customer traffic. Do you really think that's the case? We talk about it endlessly here, as you well know, and it's far from clear that there really is a deteriorating economic outlook. So what is it you're seeing that perhaps many others are not?
I think what we are seeing is pressure.
Hold on just a minute. Let me stick up for Mr. Starbucks here. He might be right. Here's the bottom line. You see UPS numbers? Dumpster fire. Dumpster fire for UPS. UPS. You see Southwest Airlines numbers? No bueno. You see Skyworks Solutions numbers? Wait till you hear Apple's guidance. No bueno. You see Estee Lauder's numbers? You see AMD's gaming business and their embedded business? The business has fallen off a cliff. They're down nearly 50% year over year. So to stick up for Mr. Starbucks here, inflation in the Fed might have done the job. And, it could be a lot of weakness being seen now.
The wallet for some of our most occasional customers. And they are translating that into what they're choosing to do.
all right, what are they doing then?
Well, so some of them are obviously visiting less, as we have seen, hence our action plan, which is about communicating value, which is about ensuring our speed of service improves, so we capture the demand that we already have, and thirdly, that we bring in products that they find exciting. What we are doing with products is, if you look at the lavender matcha, really appealed to some of these customers. We are bringing in new products as our seasonal launches go that are really appealing to these occasional customers as well. So it's about price, it's about value. We're bringing those two together to ensure that the occasional customers find it worth their while to spend their money at a Starbucks.
So, I don't really think the company has a drink problem. To me, the company has two issues, right? Obviously, the stance they took in regards to the situation there obviously hurt their business. They mentioned that in the Middle East, and it could even affect some of their customers in America, right? Some people are feel very passionate about that, and they refuse to drink Starbucks, because the stance obviously Starbucks took. So that's what people want to do. It's their money. They can do whatever they want with it, right? So that's obviously negatively affecting them. The second thing, in my opinion, is food. Food is something this company has such a tremendous opportunity, and they have the space in most of their stores to do it nowadays, but they just don't seem to be taking food very serious. And the bottom line is, if they could get food up to a level, like people crave Starbucks drinks, right? Like, people crave a Frappuccino. People crave, a nice latte and those sorts of things. People don't crave Starbucks food. I'm just going to be honest with you guys. It's very average. Very average. Like, my expectations for Starbucks food is kind of similar to, like, if you get something out of the freezer and you heat it up in your microwave, that type of quality, right? They got to bring quality up there. And so they don't have to offer a million different items that are quality, but just a few, in my opinion, to get sales up, so then at least people start taking it more serious as a food option as well. So that's kind of the two things that are going on there, right? Geopolitical situation and then food. Starbucks stock down a whopping 16 percentage points here today, one of the worst days in Starbucks Corporation's history. Stock is down about 35% in the past year. Supermicro fell over 14 percentage points here today. That stock in the past 1 month is now down 27 percentage points. Skyworks Solutions stock was down over 15% here today. It actually has basically lost all its gains on a 5-year basis now. So basically that stock is flat on a 5-year basis after losing all the gains here today. Estee Lauder stock, a stock that usually they cater to the higher end when it comes to cosmetics. That stock was down over 13 percentage points here today. That stock is down almost 30% in the past 5 years. And we're talking about arguably the most successful cosmetics and beauty company in the history of mankind. AMD stock is now down about 20 percentage points in the past month. It lost about 9% of its value here today. CVS Health just had its worst day since the great financial crisis. Worst day in about 14 years or so. CVS stock was down nearly 17 percentage points here today. That stock is now down almost 30% in the past 1 month. That's a pharmacy chain. Norwegian Cruise Line, down over 15 percentage points here today. That stock is down over 23% in the past month. Zillow Group is down 6.6% after hours right now. That stock already this year has lost over 26% of its value. That's not even including the 6% after hours. We got some things to get into in this video here today, folks, okay? First thing up, why are all these name brand companies getting destroyed? Here's where the story starts. Inflation, there's no debating, finally, after seeing earnings this earnings season, there's no debate anymore at this point in time in my mind that inflation has really hammered the folks that make under $60,000 a year. No debate anymore. People, for a while said, oh, the consumer's good, the consumer's healthy, there's no cracks in the consumer. After seeing these companies' numbers so far this earnings season, you can't make that argument anymore. The consumer is not healthy. Specifically, the consumer that makes less than $60,000 a year in income. Okay? and especially households that make less than $100,000 a year in income. Those consumers are not healthy, factually, okay? We have problems all over the place. FedEx's revenue is down over the past year. Now, keep in mind, we're in an inflationary environment, so naturally, everybody's revenue should be up in theory. When your revenue is going down and you're a big global giant like FedEx, that means people are not doing well, okay? It's not just them. UPS, their revenue was down even worse. UPS revenue down over 5% on a year-over-year basis. That's horrible. That's absolutely horrible for a company like UPS. And remember, if we go back a year ago, they were talking about goods recession, and we were in a goods recession, so we were putting it off as, weakness in UPS business model back then. And then you see we're not supposed to be in a goods recession anymore, supposedly, and yet UPS's revenue is down on a year-over-year basis, right? You look at a stock like Caterpillar, you would think Caterpillar should be revenue should be going up. We still got a lot of home building going on, clearing of land. We still got a lot of big projects going on out there. The infrastructure bill and all the money the government's pumping out there, right? And yet Caterpillar's revenues actually went down, right? That's pretty, and these are the biggest name brand companies out there. Whirlpool, they make washers, dryers, ovens, refrigerators, microwaves. Their revenue down year over year. You look at Starbucks, revenue down year over year. Now that's one that you're like, how is Starbucks that's one of those that you would usually never expect their revenues to go down for bucks, not bucks, because you can say, okay, maybe not as many people are buying homes, so maybe that hurts Whirlpool. You can make excuses for some of these companies, right? For UPS and FedEx, you say, oh, maybe Amazon, their distribution is really hurting. You can make excuses for some of these companies. By the way, the excuses really still don't count. But you could try to. When you've got a company like Starbucks, you can't make excuses. I mean, they sell things that are like $5 and $6, okay? AMD has two business lines, two of their major business lines. AMD has four major business lines. Two of their major business lines are down over 45% year over year. We're talking gaming and we're talking the embedded business. Absolute complete disaster for AMD right now. Only thing that's saving them is some of their AI capabilities and what they're doing in that data center right now. Tesla's revenues down 9% year over year. That's not good. Tesla's a company you should expect to grow almost consistently year in and year out. So what can we tell so far? Okay. What we can tell so far, and this is very important, is the most popular, most important companies that you would expect in the world are having businesses that are just kind of failing right now. Revenue is going down for these companies. And it's not even like most of these companies had exciting revenues at this time last year. That's a more troubling thing. It's like if these companies were coming off of some huge boom cycle last year and their revenues were blasted to the moon, that'd be one thing. And it's like, okay, it was just a come down. No, their revenues were not even that impressive. Look at their revenues last year and their growth rates. You're not going to find things impressive. But then things, in my opinion, elevated. They got even more serious. And it came from Meta and Amazon. And I think this matters significantly. Meta and Amazon both had weaker guidance numbers than what was expected. Both of those companies. Now, when you have two major companies like a Meta and Amazon basically put out weaker guidances, that means they're expecting the economy to get worse in this quarter. And keep in mind, these companies have already seen what has transpired in the month of April. Meta and Amazon would not put out guide numbers under what analysts are expecting unless they're expecting the economy to weaken. And what they're seeing in their April numbers tells them, you know what? Based upon what's going on in April, May and June might not be that good. Okay? And Meta's growth rate, their growth rate for this upcoming quarter should be down significantly from the previous quarter. Amazon's talking about 7 to 11% revenue growth. I mean, they came off a quarter right now where they were growing like 17%. So it's a massive, epic deceleration. There's something going on bad out there underneath things, right? Apple's reporting tomorrow. There's a high probability, I can tell you this before they even report. I'll do Tim Cook's job for them. There's a high probability that their revenue is going to be down for the remainder of this year. This is Apple. This is the big dog. Apple is another one of those that you shouldn't ever really see revenue going down. You're likely going to see revenue go down, and you could see it to go down quite a bit, folks, okay? Now, on top of that, the Fed lags. Well, you should know what the Fed lags are. If you don't know what the Fed lags are, it's essentially the Federal Reserve, whenever they make a move, it takes time for it to affect the economy negatively or positively. So let's say the Federal Reserve tomorrow lowered Fed funds rate to 0%, let's say, right? From where it's at right now, which is like 5.5%. That would affect the economy positively, but it would take some time for it to really like play out. Maybe 6 months, 12 months, 18 months, maybe 24 months, okay? Same thing when the Fed raises interest rates. It doesn't just hammer the economy immediately. It takes time. Sometimes it's more like 6 to 12 months. Sometimes it's more like 18 to 24 months. But it does eventually start to affect the economy very negatively or positively. Now, since the Fed's raised rates so aggressively, right, in 2022 and 2023, that's going to have a very negative effect overall on growth over time, right? And so we're seeing now, clear as day also, the Fed lags are simultaneously catching up. While inflation's destroyed households making under 100K a year, the Fed lags are catching up across the board, and you're seeing this everywhere, right? You look at somewhere like autos, this was back in April, and there's going to get a lot worse in regards to autos, by the way. Total early April new vehicle supply stood at about 2.77 million units. That was roughly 1% ahead of March's volume, but 46% greater than last year. Days of supply is skyrocketing for almost every single automaker out there, and you're going to start to see a lot of weakness in a lot of automakers, and you could see major layoffs coming later this year when it comes to the automakers, okay? We already seen it play out with Tesla. Tesla feels effects negative and positive before everybody else does. United States existing home sales. Recently, let's call it over the past year, we've been at numbers that are back at the great financial crisis, right? In terms of existing home sales. So that's clearly the Fed lags are catching up to things like autos, things like home sales. There's no debating that, right? Look at a company like RH's numbers that came out a week ago or so. And these numbers out of RH were bad. Revenue was down for the company. Their revenue wasn't even good last year at this time. The revenue last year was down substantially year over year, like off a cliff. And then to see their revenues go down even more, $738 million versus $772, it's just even more troubling, right? And by the way, RH caters to the wealthy. So it's not even like they're counting on, Joe, who works at the, the auto plant, makes $52,000 a year. No. They're the higher end. And so that's very, very troubling, right? Now, we also have had a very troubling trend here recently in regards to real wages, right? Wages, money people making versus inflation. This was starting to trend better, which was good, but now we just went the other way on it. Real wages are now going down. Again, for folks out there, you don't want to see that. If we look at inflation, the latest inflation numbers, the latest CPI numbers in March, it was the highest we have seen since September of 2023, right? So about 6 months or so, which is, once again, not a trend you want to see. That means the Fed has to stay higher for longer, which puts us at even more of a jeopardy of a lot of financial accidents. We'll call it that, okay? Now, in regards to CPI, some people, especially when the last numbers came out, they're saying, well, it's only things like insurance and housing and those sorts of things, right? And there's an argument to be made there. But the problem is, if you want to say it's only insurance and housing, okay, guess what people's biggest expenses are? Things like insurance and housing. So when you think about something like that, right, it's still a major issue for folks out there, and especially, once again, households that make under 100,000, which is most households out there, right? Insurance, you're seeing people's insurance rates are going up 15, 20, 25% year over year. It's a major, if you got an auto, right, and you've got to all of a sudden pay 15, 20, 25%, it's just like a massive extra tax on you. And so instead of paying $150 a month for your auto insurance, now you're paying $200. It's $50 a month less. You can pay down your credit card, or you can go out to eat, or do this or do that, and it's month after month after month you're getting taxed. Now, if your homeowner's insurance also goes up simultaneously and your health insurance goes up, it's bad. It's bad, right? Now, in regards to CPI numbers, I don't know if you guys are aware of this or not, but this matters significantly. Borrowing and debt service costs are not included in CPI at all. Some have suggested this is a deliberate omission to make inflation look lower than it really is, as evidence for this point. in fact, from the BLS, changed the definition in 1983 to exclude it. So keep in mind, if we were to have, if the inflation methodology was the same as it was back in like the 70s and early 80s, nowadays we would have probably seen CPI numbers significantly above what actually we witnessed back in the 70s and the early 80s. Just a little food for thought in regards to that. The government changed a lot of data to like make things look a lot better than what they are in reality. Okay, so the moral of this story so far is none of this is good, right? We're getting. I always, you know, who I always pay attention to the most to really understand what's going on in the economy. I don't pay attention to the government numbers as much. Government numbers, I'll look at them all, okay. I don't care about any of that nearly as much as I care about companies, especially big dog companies. How are those companies doing? That's what I want to know. How are the big dog companies doing? Because there's no lying, there's no fudge in those numbers. If you're a big dog company and your revenue is down 5% year over year, it's down 5% year over year, and you got to report that. There's no tricks and gimmicks to get out of that one. You can if you're talking about your non-GAAP EPS or something like that, but not revenue. No, you go to jail if you're fudging your revenue in your company. So troubling, very, very troubling overall in regards to that.